When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you the straight talk and honest insight you need to help you achieve your financial goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing today, Dave?
I'm doing good. Sure great, as always, to be back with you. I enjoy these shows and the chance to talk with you and interact with the public.
Me too, Dave. It's always a good time when you and I are together on the radio, or in this case, on the podcast, to talk about all things financial, because you do have so much great information there at ILG Financial. Dave got a question last week from a listener, and he said this. He said, Dave's initials are DL, so why is it ILG Financial? What does ILG stand for?
Yeah, that's a great question. ILG stands for income, the L is for legacy, and the G is for growth. And the reason we use those terms, I is for income, L is for legacy, and G is for growth. And the reason we chose those three letters is that as we've built out plans over the years, Jeff, what we have found, and we do this for everybody that we meet with, is we build out a comprehensive retirement plan for them. And it will be based on those three pillars. We're going to have to account for each of those three items when we're building out a plan. And the result is a different, unique plan for each individual based on their income needs, based on their goals as far as legacy for their heirs, and how much risk or growth they're willing to do. And of course, more growth sometimes mean we're willing to take more risk. So there's a risk analysis that has to take over. So over and over in building the plans, these three pillars came up. So it was very easy to kind of name the company that. But you know what? We thought it was too long to name the company Income, Legacy, Growth Financial. So there you go.
ILG, Income, Legacy, and Growth. Okay, well, that makes a lot of sense. You need the income. Of course, legacy is very important. Passing on the assets. And of course, you want some growth. These days, I think people are just looking for safety at this point, preserving what they have. But of course, everybody really would love to have some growth. You mentioned about that financial plan. And for our new podcast listeners who may not know this, Dave is offering a financial plan with no cost, no obligation whatsoever. To get yours, call 540-720-5656. Also at ilgfinancial.com. Well, Dave, on today's show, we want to talk a little bit about diversity, and in particular, two items that make up part of a portfolio, stocks and bonds. So the title of today's podcast is Stocks Outperforming Bonds. Buy and hold. Now, that's the mantra that we have all heard, right? Buy and hold long enough and your stocks will outperform your bonds. But how long are we supposed to hold for this to be true? Well, surely no longer than 15, 20 years, right? Well, today we want to dig into the facts and data surrounding the age-old belief that stocks outperform bonds and that you'll be fine with a combination of stocks and bonds.
That's right, Jeff. And to do that, what I want to do is we are going to be discussing an article by a gentleman by the name of Mark Hulbert. The article was titled, "Here Are Your Odds That the Stocks Will Outperform Bonds Over the Next 20 Years." And after listening to the podcast, if anyone wants more details on this article or the research that backs it up, just give the office a call and we can give it to you. But the article, which was published August 10th, I believe, it draws on research posted recently on the Social Science Research Network. And it was research conducted by a gentleman by the name of Edward McQuarrie. Now, McQuarrie is a professor emeritus at the Levy School of Business in Santa Clara, California. And he has spent years reconstructing the history of the U.S. stock and bond market and their returns. And he's gotten some very interesting data that we're going to spend today talking about.
The article proposes that the accepted investment advice is stocks always outperform bonds over longer periods of time. May not be true. Dave, how long would we need to hold stocks to be confident that we would outperform bonds based on this new data?
Well, it's interesting. The reality is you may need to hold closer to 150 years. Now, that sounds ridiculous, right?
Yeah.
But we're talking about, and we do this all the time when we're building plans out, Jeff. We say, forget the sound bites, forget the advice from friends who don't have any data to back it up. Let's see what the data tells us. Facts and data is really how you want to be building out your plan. And based on this data by Macquarie, the data says you may need to hold your stocks for closer to 150 years to give you the, based on past performance, a confidence that you're going to outperform bonds. Now, let's take a closer look at that. I'm going to give you a concrete example. A lot of folks don't know this because it's not included in the data that's used by the Wall Street community that's trying to make the case right now that stocks always outperform bonds. And the data is this. From 1793 to 1942, now that's a period of roughly 150 years, right? 1793 to 1942, right up to World War II, the bond market in the U.S. actually outperformed the stock market.
Now, Dave, does this mean that stocks and bonds have the same risk level?
No, what it's actually saying, Jeff, is that contrary to popular belief, over time periods shorter than 150 years, and that's the key. Isn't that important? Because most folks, and I would argue all, right, but most folks that we deal with, their time frame for using their money or getting in and out of the stock market is smaller than 150 years. Wouldn't you agree?
Absolutely.
Right. So this is very relevant to folks in or near retirement or anybody who's not investing in some multi-generational trust that they're not touching and their kids aren't touching and is proposed to be used by their great-grandchildren. So contrary to popular belief, over periods of shorter than 150 years, what this is really saying is stocks are really no riskier than bonds, but it's because bonds are actually riskier than we thought. And accordingly, because of the higher risk, they can produce over periods higher rates of returns that makes them closer to the risk and the performance that we've seen or been advertised to see in the stock market.
So, Dave, when we're told to hold for the long term, what exactly does that mean? I mean, how long is the long term?
Yeah, so we do a presentation and we joke about this, but in all seriousness, if you came to me, Jeff, and you said, Dave, I want to put my money in the stock market, and I've heard over time the market always goes up. You've heard that, haven't you?
Absolutely, yeah.
Yeah, and the data suggests that, right? So what I would say is that, well, whether we get into the market or not, it really depends on how you plan to use this money. So I said, Jeff, what's your goal? What do you plan to do with this bucket of money? And you said, well, Dave, I talked to my wife, and we don't need it for a while, but we are planning to use it on a down payment in our house. So the plan is set it, let it grow, and in 150 years and not a day longer, we're going to take that money out and buy a house, right?
I can't imagine how much the house would cost in 150 years.
Well, that's why you need growth. Right? So imagine if that was, when we joke about that, but if that was the case based on the data, I would be confident saying, if you're not touching the money for 150 years, I'm very confident, let's go in the stock market, and it doesn't matter if it's at all-time highs, it doesn't matter if a correction's imminent, because over time, history has said, over those long windows, we're going to get a positive return. So that's the time frame. So it really begs the question, what if I need my money over shorter periods? And by shorter, I mean anything shorter than 150 years. Well, what we're talking about today is the data suggests that over shorter periods of time, not only does the market not always go up, but it doesn't even necessarily outperform the bond market, which we assumed was fact. Now, let me give you some concrete examples. You hear people all the time, Jeff, saying we're living in unprecedented times, specifically when we're referring here to what's going on with the pandemic. Would you agree?
Absolutely. We've never been here before.
Right. And then the implication is, other than this little pandemic window, what we've seen over our lifetime in the stock market the last 50 or 60 years is the norm. But the data is saying that's not the case at all, right? So who's to say, remember I mentioned earlier that over the period 150 years from 1793 to roughly World War II, 45, bonds actually outperformed stocks, right? Well, who's to say that that's not the norm and we are now living in unprecedented times or an anomaly? And we're going to move back to that model for the next 20, 30, or 50 years. So is the buy and hold model that we've been taught Is it really worth it if you've got to wait so long that you don't live to see the rewards, meaning over 20, 30, or 40 years? Another way of saying this is, Jeff, have you heard of the term equity premium?
Yeah, I've heard of that. I don't quite understand it, but I have heard of it.
Yeah, a lot of clients haven't heard of the term. It's used in the financial world. The equity premium, to put it simply, is really the amount by which we expect stocks to outperform bonds. The theory is, hey, I take more risk in the stock market because I'm expecting a better return. Make sense?
Makes a lot of sense to me.
Right. So the equity premium, according to Macquarie's research, it suggests that the equity premium is much smaller than people have assumed over the past. So I'll give you an example. Since 1942, which is usually the time period that Wall Street uses for all of their data, the equity premium has been about 5.1%. And what that means simply is people who take risk in the stock market, have some in stocks and some in bonds, Jeff, are expecting to get about 5% more from their stock portfolio than from their bond portfolio, and it's going to be more volatile. Well, the data says over the entire 225 years that we can go back and measure, going again back to 1793, stocks beat bonds by 1.7%, much lower. In fact, a third of what we have seen from 42 on. So what does that tell us? Now that we have the full history, looking back the entire 225 years, it's really hard to sidestep the conclusion that anybody that's telling you that stocks outperform bonds over time, historically by 5 or 6%, are by definition cherry picking the data, just picking the best period here from a 70 or 80 year period out of 225 years. And if you look at all of the data, you get a much different conclusion.
Well, Dave, I wish I had bought Apple stock back in 1793, but it probably wouldn't have been Apple as we know it. It would have been an apple orchard or something like that. So what does this mean about our belief that stocks will always outperform bonds?
It means that the odds that bonds are going to lag behind stocks over any 20-year period are much lower than we previously assumed. According to Macquarie's data, you've got a 62% chance over he's looked at every rolling 20-year period going back to the 1793. He said you only have a 62% chance that stocks over that 20-year window will beat bonds. Most people would be amazed by that data. So that's the first takeaway. The second one is just be aware that 62% stock outperforming bonds is much smaller than we previously assumed, and it's certainly smaller than most retail investors would assume when they're deciding how much to put in stocks and how much to put in bonds or other principal protected vehicles. There's several out there. So focusing on recent data, this is the third takeaway, right? If you're just picking most recent data, not all the data, like Macquarie did, you're cherry picking data, and that doesn't necessarily give you the results that you're going to expect.
Dave, there's a lot of great information here, and with all this being said, how should we approach the stock market moving forward then?
Well, a couple things I would suggest based on the new data. One is that if everything's moving along in a normal market, right, and we're not talking about this pandemic stuff that's going on, just be aware that you've got just over a 50% chance, 62 to be exact, of stocks beating bonds. And that might drastically change how much money you allot to the stock market versus how much you allot to bonds or how much you allot to other principal protected vehicles. So a lot of folks come to me right now and they'll say, well, based on this data, surely that's not true now because we are in, historically low interest rates. Right now the U.S. Treasury bond is, roughly 1 to 1.25%. That's 500-year lows for interest rates, right? If interest rates stay this low, surely we can expect stocks to outperform. What if interest rates stay at this 1 to 1.25 margin all the way, for the next 20 years to 2040? Are stocks going to outperform?
So, Dave, since interest rates are so low, doesn't that mean that stocks have a better chance of beating bonds than the overall 227-year record would suggest?
Well, I'm not sure it does. And to test the argument, Macquarie actually analyzed each and every year going back all the way to the 1793 period, right? And what he did, which is very interesting, he actually measured the correlation between the year's interest rate, and remember we talked about equity premium? The equity premium return over the next 20 years. And what he found, and this is key, in no event was there any pattern that met traditional standards of a statistical significance. And what that means is, that's fancy talk, right? That means that the odds of stocks outperforming bonds over the next 20 years are no different just because interest rates are low. And that is a huge takeaway. So even with interest rates here at all-time lows, there's no reason to think we have any better than a 60 to 62% chance of stocks outperforming those low interest rates.
So, Dave, what is the takeaway of all this Macquarie research?
Well, with respect to his research, I'd say a couple takeaways from this podcast. One is that your stock bond portfolio will not reduce your risk as much as maybe you previously have thought, because bonds are actually a little more risky than we had thought. The second thing, Jeff, would be that the equity premium that we've been talking about, the amount we expect stocks to outperform bonds, is much lower than we had previously thought, which might drastically, again, change your allocation to the amount you have in stocks versus bonds or other safe vehicles. So the zigs of one, we thought, would be able to offset the zags of the others, meaning when one went up, the other went down. And the data suggests that that's not necessarily accurate at all. Now, the big takeaway, right, for our listeners today, which is really this kind of the sound bite, is that the idea that you should just put 60% in stocks and 40 in bonds, cross your fingers and everything's going to work out. I would suggest that this data suggests that that assumption is flawed, that based on statistical data, and we've been talking about statistical data for years with our clients, that you need a broader diversification, a broader collection of investment vehicles to get the right combination of investments based on your specific goals, that there's no one-size-fits-all model. And the way to do that is to meet with someone like us, who specializes specifically in building out comprehensive, holistic retirement plans, and then we can look at specifically what you're trying to accomplish and look for specific investments and combinations of investments that ideally are going to give you the best chance of success based on fact and data, and ideally by taking as little risk as possible. So that's the takeaway I would suggest.
So, Dave, the old adage of 60% stocks, 40% in bonds is just, that's a cookie-cutter template that doesn't work for everybody. And if I'm correct, if I'm hearing you correctly, Dave, what you're doing is when you do these financial plans, you sort of throw that out the window completely, because you've got to take the information from the person who's getting this plan to build a plan that will work for them, and it may be a much different ratio of stocks and bonds.
That's right. And just as importantly, as you move into retirement, there's other investment vehicles that you may need and want to include to give you a better chance of success based on whatever your definition of success is in retirement.
And of course, success means different things to different people. It isn't all about being, the richest person in the graveyard when you pass away there, having the most money. I think wealth and success can be measured in a lot of ways. I mean, you can have a lot of money, you can buy a house, but it won't make you a home. So think about what is important to you in retirement when you build out this financial plan. And Dave, when you do build out these financial plans, I mean, stocks and bonds, those aren't the only things that go into a financial plan. You've got a lot of other tools in your toolbox, don't you?
Yeah, and I would suggest for anyone listening, you do not want to limit your chance for success simply because you're limiting the number of tools that you're looking at. When you went into Home Depot to build a shed, you wouldn't say, well, listen, I've always used a manual rip saw, a Phillips screwdriver, and a hammer. I only want to look at those tools, right? What you would do is defer to the expert based on your project, and he's going to introduce a whole array of tools that you may not even be aware of and talk to you about how, based on your specific project, this tool might be a better fit. We do the exact same thing with our clients, right? Right tool for the right job. So you want to consider things, not just bonds and stocks, but you might look at participating in equities using exchange-traded funds and having them managed in a certain way so you limit downside. We can do that type of a thing for folks. You may want to look at types of annuities if you're looking for income, or you want protected growth and a chance to do better than stocks or bonds, but still have that protection over time. There's different types of annuities, not built for income, but built for growth. A lot of people don't know that. And then there's certain types of CD packages that people are unaware of that can give you a chance for a little bit of better protected growth. growth. And folks just aren't aware of these type tools, but they can be very beneficial. And in the end, if you're using the right tool, just like if you're building a shed, it gives you the opportunity to accomplish the job quicker, with less risk, and with less effort. And that's the same thing you do for building a project is what we want to do, and we do for clients every day when we're building out their retirement plan.
Dave, we've talked about the right tool for the right job many times in this program, and it's interesting. In your book, Mama's Secret Recipe for Retirement Success, you relate a story about your shop teacher. I mean, you learned this many, many years ago, didn't you?
Oh, I know, and it's funny that it's stuck with me, for 40 years, this comment that my 7th grade shop teacher made in passing. It was our first day of shop class, and you can imagine what a 7th grader felt like looking for the first time at a whole wall. You remember how the whole wall was of tools?
Oh, yeah.
And we really wanted to jump in and just start grabbing tools, and we had to sit there and listen to the safety lecture first. And one of the things he said was, kids, right tool for the right job. And that has stuck with me all these years as I've seen it applied in my life, as I've seen it applied in projects that I did, and as we've just grown ILG Financial over the last 11 years and built hundreds and hundreds of plans, we have actually implemented that piece of advice from Mr. Adamusco 40 years ago into each and every retirement plan we've built. And it's find out what the goal is, find out the amount of risk the client's willing to take and what their timeline is, then look at the assets they have available to make their dreams and their goals happen, and then systematically, based on fact and data, put together a combination of the right tools. And as a fiduciary, we really don't have a dog in the hunt, which is why you want to be looking for a fiduciary advisor, right, Jeff? You don't want someone who's only selling stocks and bonds. You also don't want someone who's just selling life insurance or annuities. Ideally, you want to get to someone who sells everything. And that's where we are. We put ourselves in a position where really all the investment tools that are out there are available through ILG Financial. So we literally do not have a dog in the hunt. We're not trying to push one tool over the other any more than Mr. Adamusco was trying to drive us to one tool when we're doing a project. We do the same thing he did, which is outline the project, get a clear understanding of what we're trying to accomplish, and then handpick the right combination of investment tools for you to give you the greatest chance for success and ideally taking as little risk as possible.
Well, I'm sure that Mr. A would be very proud to know that his advice of right tool for the right job has stayed with you your entire life. That's a good teacher there. Income legacy growth, it's all right here at ILG Financial, and it's about helping you plan for retirement your way so you can achieve your financial goals. So call ILG Financial 540-720-5656 or go online to ilgfinancial.com to learn more and to get your complimentary financial plan. Well, Dave, so much to talk about, so little time. This is a podcast, though, and we can continue this, of course, next week. And for our listeners, of course, this being a podcast, if you've missed any of our previous podcasts, they're all right here available for you to listen to here from this website or wherever great podcasts are heard. So, Dave, we're out of time for this week. I want to thank everyone for listening and invite them to join us again next week for another edition of Retire Your Way with Dave Lopez. Have a great week.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial, LLC are independent entities.